Good morning, everybody, and welcome to the Better Investor Conference, hosted by Moneyweb. My name is Rish Tandapany, Group COO of the Purple Group and EasyEquities. Usually when I start these type of talks, I give everyone a bit of an overview as to who I am, where I've come from, and what I've done. But today I'm going to try something a bit different. I'm going to tell you guys a bit about a story that happened to me quite recently. I was on a plane ride back to Singapore, where I reside, from Johannesburg. And in that typical type of airplane environment, someone asked me who I am and what do I do. Now, usually dreading these type of conversations, I usually keep my answers quite brief and don't really go into much details. I usually just explain to people how I'm a COO. I help manage operations of the company I'm working for and do bits of work on strategy and people management. However, this time I was a bit flustered, and the reason being that the person asking the question to me was an 11-year-old girl. So how do I go about answering to her? What do I do? Who I am? What do I actually do on a day-to-day basis from a job perspective? It was interesting. Now, I thought about two different approaches to this. Do I tell her what I just told you guys about what I do? Or do I tell her actually what my company and I do to enhance her lifestyle? Now, as you can imagine, an 11-year-old girl can be quite daunting. She's in that typical Gen Alpha, and yes, that is a real word, age group. And it was something that I thought I owed her a better explanation towards. So I told her, I help build tools that make growing your money easier and faster. And straight away in her eyes, I could see that resonates. I could see her percolating, thinking about how her pocket money can somewhat double or triple or quadruple. Now, why do we never think about that from an investing community? Why do we never think about how we portray ourselves and how we're portraying the wider investment arena? There's two options again. There's the bad news. Do we talk about inflation, oil prices, impending recessions? All terms that an 11-year-old won't necessarily understand. Or do you try to sum it up in a more positive and flamboyant way? So I told her, how would you feel if today you gave me $1,000 and in 40 years' time, I gave you something northward of $70,000? Again, her eyes lit up, and I could see there was somewhat more of an interest in her listening to me. So let's just take a minute and talk about the bad news. Why is the market so currently bad? We can talk about sharp corrections from COVID when the markets were high, the economic hangover that we're all thinking about. High energy prices is something I discuss with people on a day-to-day basis. Rising interest rates, Ukraine. We're seeing unprecedented inflation, probably higher than it has been since the 1980s. Lower consumer spending, which I think all of us can empathize with. But the net impact of all of those factors means that the businesses we're investing in essentially are making less profits. And as a result, our view on the market changes. But how does that look in the eyes of an 11-year-old girl? Well, it doesn't look anyway. It just looks like bad news, let alone anyone else. So we need to start thinking about how we're projecting ourselves in our arena. We need to start thinking about how do we talk to those 11-year-old girls, those 21-year-old men, those 75-year-old retirees. Take a step back for a minute. Look at something like the JSE 40 index or the FTSE 100 from a pure graphical standpoint. You'll see peaks and troughs. You'll see the 2002 dot-com bubble. You'll see the 2008 mortgage crisis. You'll see the recent pandemic sell-off that we've all experienced. These cycles are normal. And ironically enough, explaining those cycles in the grand scheme of a 30 to 40 year graph actually resonates more with a child or someone younger than it does with someone my age or someone older. And why is that? Maybe generally, younger people are more positive. Maybe they see more of a stronger, resonating outlook with regards to their money. Or maybe, as an industry, we've just sat ourselves in that seat of negativity for so long. So, corrections or cycles, they have to happen. That's what keeps things in order. And we all know that, but that doesn't necessarily stop us from becoming anxious investors. And I think this is one of the properties that we can learn from the younger generations, millennials and youngers, even the Gen Alphas who I was sat next to, where there's an aura of positivity and there's an aura of positive outlook generally in the way they approach their money and the way they approach investing. And I think that's critical going forward. Once again, I use the example. How do we turn $1,000 into something northward of $70,000? Simple. We just stick in the market. It's not complicated, and we all know it. But critical to that is looking past the volatility. It's an opportunity for us. And especially now, in the middle of June, we're seeing huge problems with the market. We're seeing huge amounts of negative news on a day-to-day basis. But actually, if we step ourselves out of that equation, we can actually understand things in a much more coherent and concise fashion. And we know the answers already. It's nothing new. We've all experienced it before. Volatility goes both ways. The larger the red candles, the larger the green ones. We need to stop approaching investing and investors on a cliche level. Markets do well, growth stocks do well. Markets are turbulent, so we'd be better off sitting safely with ETFs and indexes. Yes, all factually true comments, but ultimately don't really change anything from our investing outlook. We know that, we've committed to the program, we should stick with it. And that's where we can learn a lot from others. So why am I telling you this story? 3 reasons actually. 1, that actually an investor can be anyone. And do we all really believe that? Are we still all living in that 1980s, 90s demographic of what an investor is or are? Well, actually, to me, and everyone within my team at EasyEquities, an investor can be anyone. We don't discriminate by age, we don't discriminate by gender or by wealth. We actively try to target everyone. And an investor can take any shape and form. And that 11-year-old girl really pushed that message across with me. I think the other thing to consider is rethinking our roles within this process. So what am I? Am I a COO of a financial services institution? Probably yes, on paper. But what do I actually do? 2 key things. I educate and I provide technology. Who do I educate? I educate my own teams. Teach them what I know about the market. Teach them what I know about what clients want. Teach them what I know about technological provision. And externally, I have a commitment as a financial institution personnel to help grow their database, grow their knowledge and the facts that go out to them. So I'm much more of an educator, and somehow that sits a lot better with me than just that quintessential COO title. The third reason why I told you this story is pretty simple. Maybe it's time we reassess how we approach the idea of helping people invest and why we want them to be embedded within that process. There's always been a distance between financial institutions and the consumer and retail investors. Well, that distance needs to narrow. And the reasons for that are pretty simple. 1, maybe consumers are smarter than we actually think. Maybe the retail investors are the ones who actually can provide a lot of the answers that we crave. I'll give you an example. Crypto recently, or in the last 5 to 10 years, taken a big step into the game. And it's been seen as the principal means to democratizing finance. In fact, it's coined the term DeFi. I'm not so sure about that, but I do agree, and we can take the lessons of crypto, that consumer input will define the financial services industry more now than ever. So maybe it's time we, as investment professionals, listen more and speak less. I think that's a critical message I'll give to any of you. A lot of the answers are already out there, whether it's in a different geography, with a different demographic, or with different partners. And maybe now is the time to start that collaboration exercise. Let's just take a step back and look at South Africa for a moment. In recent weeks, we've seen large bond outflows, the falling appetite for local debt, and price hikes that have hit unprecedented levels. Well, okay, 3 huge pieces of negative or bad news. But we've heard little in terms of diversification. We've heard little in terms of property, emerging markets funds, or crypto. We've heard nothing, or next to nothing, in terms of international and regional opportunities. Let's take a look at the recent Sanlam Alliance joint venture. That's a huge pivotal movement in East Africa. It comes with opportunity, both in the alternate investment space and from an innovation perspective. And if you group those words together, what do you have? Potential. So we can't always get bogged down at a micro level on the acute details that are just spawned from negative news and negative feeds. It's time to look a bit broader, and it's time to look at investment and investing as a slightly more broader concept. And we'll get onto that later. Let's think about things from a slightly wider market perspective. I would say we're probably going to see another 20 to 40% drawdown in the market over the next 6 months. That isn't necessarily anything new. It isn't necessarily time to fear. It's probably a time to get your ducks in order and ensure that when things do turn, you've made the right, sensible decisions to continue your investment strategy and the path with which you started many, many months or many, many years ago. And all these factors come together into what I call coherent investing. Clear, concise, ideal investing that allows you to understand your situation now, in the past, and in the future. And that's a key takeaway for all of you guys here today. So how do we go about understanding our investment mindset or our behaviors? Critical to this is understanding your risk appetite. How much are you actually willing to spend at a given time to make the money that you want to achieve at a given point in the future? Well, key to this is sticking to an investment plan. Now, your advisors can come up with this, but you need to know the underlying logic and realities behind that plan. Plan your trade and trade your plan. It's like every walk of life. You try to approach it with a sense of sensibility and also a sense of routine. And an investment plan is exactly that. So whether you're getting advice from a third party or you're taking the advice that you're giving yourself, execute that investment plan in the way that you want to execute it. What likely was good for you 6 months ago is likely still good now. Just don't let that shroud of negativity necessarily outweigh your decision-making on your portfolio. Don't emotionally trade. Critical, and probably one of the number one things I see on a day-to-day basis that impacts people's portfolios. I'll give you a bit of a side story on this that helps me explain emotional trading. I came to Singapore about 14 years ago. And when I first joined the bank I was working with at the time, someone came to me with this idea of time trading, which I automatically assumed meant timing the market, which we all know we shouldn't be doing. But actually, that person said to me, well, no, it's more about understanding how your mood dictates your trading behavior. And he brought in factors like the moon and its gravitational pull with the earth and how it affects water, waxing crescent movements, things like that. All in all, and to cut a long story short, it explained to me that people are still being overly sentimental and overly emotional with the way they trade. Now, there is a part of you that can include that within your investment plan, and we'll get onto that later when we talk about values. But on a day-to-day basis, the more emotionally invested you are in making those decisions, the likely your trading is going to be effective, and your investment plan as a whole will be effective. As I mentioned earlier, don't time the market. Try to understand from an education and logic standpoint what your behavior actually means. A good example is dollar cost averaging. See the meaning behind it, understand the logic, and understand how that fits into a more realistic, wholesome, likely to succeed plan. So I guess all this comes down to discipline. So let's take a look at some micro habits that can help you with discipline. The principle of which is probably staging your investment over time. A lot of people make the critical mistake of just plunging all their money into a hot stock or into a particular investment strategy immediately. They don't necessarily think about staging. But think about your children. You don't necessarily take plunges with them. Your relationships, you don't necessarily take plunges with those also. When you're buying a property, you don't necessarily go on day one and say, well, that's it. It's a thought out process, which can be done over various stages. So let me give you some use case examples, which I think will be very, very helpful. Let's take crypto as for the first one, which hopefully illustrates the market and investing in very simple terms. We've always treated crypto as a trading product, which has always not sat really well with me. It's an investment product. And for those of you who know the markets, either from a technical standpoint or just generally, you will admit that it's an investment product. Essentially, what we're trying to do with crypto is to see it develop and mature into something like gold, which takes time. It takes time to become that pure, mature investment product. The reason the Bitcoin fluctuations have happened over recent weeks and months is purely because new investors are selling and older buying. So why are we not listening to the older investors, or those who have been in the crypto game for slightly longer? Essentially, crypto is going to be dictated by when companies hold it on their balance sheet. As soon as we see that movement, volatility is going to come down, and we're going to be looking at the new gold. Now we just call crypto or Bitcoin a financial technology. Soon, it's going to be more associated with store value, and everything's going to be a bit more mature. Now, you wouldn't know that unless you knew and educated yourself on the product and how the market works. And I think that's critical. An immersion factor into understanding what it is you're getting involved in. The second use case I'd like to tell you guys about revolves around impact investing. To me, this is critical and probably the most important thing that I speak to you about today. The alignment of personal values and financial performance is key. It has been key since the millennials, and is definitely going to be more and more key, more and more generations come on board. I can see it with the Gen Alpha who was sitting next to me. She wants her money to be associated with the values, missions, and ethics that she lives and prides herself on a day-to-day basis. And the critical to understanding this is the idea that value isn't just a measure of profit anymore. It's much more than that. It's a measure of meaning. And for all of us in the investment space, either as investors or investment professionals, we need to understand about how we're generating value. And that necessarily isn't always a financial number. The idea of personal value investors, those who want to align their personal values with their investments, is going to be critical and represent a huge proportion and probably a majority of the client base that all of us are going to see over the next months. So think about your personal value investment proposition. As mentioned earlier, some micro habits on what we can and can't do, or what we should and shouldn't do when it comes to our investments. These are what I would call more grounded pieces of advice. Don't always check your stock prices. If you're doing that, you're looking more for validation than logic. Think of the fundamentals more than the day-to-day news. A good example of this is Apple. Apple don't release phones or tidbits about their phones on a day-to-day basis. They do it in 6-month chunks, maybe 5 or 4-month chunks. And as a result, we see peaks and troughs in their stock prices according to that. So why are we looking at stock prices on a day-to-day basis? It's an investment product, not a trading product. It's important to understand that. Think of your interests and align them to your values. Is the company that you want to invest listed? Is it not? Make your decisions based on those type of factors. And the thing that I mentioned earlier, immersion. Immersion from an education standpoint is paramount to any successful strategy. Financial, technical, geopolitical, sociological immersion is critical. And that's one of the key factors that I drive at EasyEquities. So how do I come into this? How does a COO of EasyEquities actually play a role in this? Well, principally is to tell you that our job at EasyEquities isn't to advise you. It's to equip you to advise yourself. A paramount part of our mission and a key driver of our value proposition is the idea of education and technological facilitation. How are we immersing our clients with as much data and information to make their investment decision-making tree robust, strong, valid, and more importantly, successful? And what technology are we putting out there to ensure that that journey is both easy, yes, the clue is in the name, low cost, we obviously want to squeeze on margins, flexible, and more importantly, built in with a sense of community. If your investment strategy is pretty much part of a community strategy, or at least being bounced off eyes and ears within that community, there's more chance it's going to be successful. And so we take an outlook that education and technological facilitation is absolutely key. And how do we achieve that? Well, we talk to our clients, but not just them. We talk to our fintech partners. We talk to our distribution channels, our regulators. There will be significantly more chance of success working together than working separately. And for all of those of you in the room, Not everything should be seen as a combative, competing relationship. We need to understand how that can be symbiotic. How can we get the best out of each other and help the wider investment community? And it goes back to the point I made earlier, which was, do we understand our roles within investing? Yes, we're essentially part of a capitalist industry, but it doesn't necessarily mean we always have to be at loggerheads with each other. There's a greater requirement for sharing, partnerships, and cohesion. Shared distribution channels is pivotal, especially as some of our entities go global and our product offering increases. And more importantly, from a technological standpoint, we need to collaborate. We need to ensure that we're leveraging off the best technology out there. Now, EasyEquities may not always produce that, but we're quick to identify who will, and we join forces. And it's very important to see this from a collaboration standpoint. In essence, what are we doing? We're building a community. And why is that important? Well, essentially, the community dictates whether the market goes up or goes down. It dictates whether we succeed or whether we fail. Our goal at EasyEquities isn't just to be a stockbroker or your quintessential brokerage. Our goal is to offer a holistic view of any of our clients' finances. Imagine your balance sheet online with EasyEquities, where you can see your life insurance, your lending portfolio, your crypto portfolio, your stocks, your children's education loans. That's where we're aiming for. Now, granted, we haven't achieved much of that as yet, but we're getting there. And the way we're getting there is by talking to our clients, our partners, our distribution channels, and ensuring we're all working in that same direction. You've probably all heard about the creator economy that's coming our way. Well, I think that's here to stay. It's driven by community. It's driven by a sense of decentralization as well. And EasyEquities aims to invest and embrace in it, not to go up against it. And if our clients, principal players in that creative economy, we'd be silly not to listen to them. Now, imagine a world where everything is easy. That's what I want as COO of EasyEquities. I want everything to be easy, both in functionality and in name. I'll leave you with a piece of advice that someone gave me a few years ago. They said to me, Rish, well, always seek help, even in times when you don't necessarily need it. I never really listened to that until recently. But now, with my arena, with partners, regulators, distribution channels, I think it's always important to engage those people. And I can see that on a day-to-day basis, me having those conversations adds significantly more value than me not having those conversations. A lot of people ask me, well, what does the future hold? I'm not so sure. I'm not a genius, so I don't know the answer to that. But I do know that the future is easy. Thank you, and enjoy the rest of the Better Investor Conference.